Thanks for clicking! Canada's real estate market was poised for a comeback just before President Trump got elected, and now the biggest risk to the housing market is stagflation. This according to a new report coming from the Globe and Mail. And that's an interesting assertion, not the assertion that the market was just about to take off before Trump's election. We've heard that evidence-free argument from the usual suspects ad nauseum for months now. An argument so compelling that the only evidence proffered by the Globe and Mail was the fact that Bank of Canada Governor Macklem said as much.
Trust everyone.
No, but seriously, the Globe's argument that stagflation, high unemployment and high inflation, what global news calls an economic kiss of death, could be on the horizon and that it could be the most significant headwind to Canada's real estate market, is one worthy of consideration, especially since we're not exactly starting out the trade war in the strongest position. So what I want to do today is very briefly go over stagflation, take a look at how Canada's housing market behaved the last time that phenomenon occurred in the early 1980s, and then discuss the extent to which those processes are likely to repeat themselves this time around. As we'll see today, while there are some similarities between right now and the 1980s, there are also some very key differences that lead to a very uncertain future. We will obviously continue to track how this all plays out on this channel. Make sure you click like and subscribe if you want to get those updates, but for now, let's get into stagflation. On to stagflation very briefly. As mentioned, stagflation is low growth, high unemployment, and high inflation. It creates a real problem for central banks as they're hesitant to lower rates to help with the economy, as that's going to push up inflation. On the other hand, they're hesitant to raise rates to lower inflation, as that will put more upward pressure on unemployment, hurting the economy even more. And although to my knowledge we don't have any hard and fast dates for when stagflation officially occurred and ended in Canada, if we take a look at the graph, we can see it generally occurring between 1980 and 1983, when we had at that point ultra-high inflation at 12.4% and unemployment hitting 13.1%. And then of course to deal with that ultra-high inflation, then Bank of Canada Governor Gerald Bowie raised interest rates, with the prime rate reaching 22.5% by August of 1981. So, what happened to the housing market during that period of time? Well, as you might imagine, with interest rates nearly doubling and people losing their jobs en masse, prices fell during that period.
Shock and disbelief tonight.
It's true. Prices fell as the percentage of disposable income needed to buy a home skyrocketed upwards. Accounts differ as to exactly how much prices fell during the early 80s. WOWA says 14%, the Federal Reserve says 8.5%, 17.5% when adjusted for inflation. In some markets, people just walked away from their homes. Mortgage defaults hit record highs, with delinquencies coming right in around 0.8%, compared with the 0.17%, though rising, that Canada is seeing right now. And we can see the effects of the drop in prices occurring in that period happening right away, with real house prices actually dropped below income after bubbling up over the past few years prior. Granted, they exploded much higher in the decades that preceded that as the central banks consistently pushed down interest rates to the floor, ultimately hitting asset prices. But for that brief period in time, stagflation actually pricked the property bubble. But it's little wonder why there was minimal demand for real estate during that period. Let's take a look at the average price in 1981 of $76,000. Say you could borrow at that time at prime of 22.5%. We'll go 20% down payment on a 25-year amortization. We get a mortgage payment of $1,095. Annualize that at $13,140 per year. That's 29.7% of the average income at the time. And as to how much of the shock that was, well, the year prior, the average price of a home was $67,000. Prime was running at 12.25, meaning the payment was about $562 per month. Annualized at about $6,700, or 14.8% of average income. So the percentage of income needed to buy that average priced home doubled in just the period of 1 year. Combine that with ultra-high unemployment, a lethal combination for any housing market.
This is as good as it gets.
So, when we saw stagflation in the 1980s, we also saw major decreases in real estate prices, especially adjusting for inflation, brought on by higher interest rates and high unemployment. So, what's the likelihood of this double whammy hitting again? High interest rates brought on by high inflation and high unemployment. And if we do see that, was the likelihood that it hits the housing market. On the interest rate and inflation front back in the 80s, we have two generally accepted causes. The first being the second oil shock, which saw oil prices nearly triple within the period of a year. Second, the Bank of Canada, and all central banks really, were slow to raise interest rates when inflation started ticking up in the 1970s. There's also leftover effects from when Nixon took the United States off the gold standard. But let's not get too much into the weeds on that right now, as I'm sure it will be coming up in the future. Fast forward to right now, and very few, if any, project the Trump tariffs to push inflation anywhere close to as high as oil did in the early 1980s. Oxford Economics is projecting 3% in 26, the Bank of Canada expects 3% in and around in 26, and the OECD says that inflation is expected to come in at around 3.1 as well. Canada has seen some stickiness in its inflation rate over the past few years, though nothing like what it saw in the late 1970s. Meaning, nominal interest rate, the interest rates coming from the Bank of Canada, shouldn't have to go nearly as high as they did in the early 80s. Again, though, I can't stress this enough, that's all else being equal. The Bank of Canada, the powers that be, the OECD, etc., we all know how wrong they were with low to 2023.
He's doing his best.
So, with inflation not set to hit 12.5% anytime soon, that means that interest rates should be able to stay relatively contained, at least relative to where they were in the 1980s, with the OECD predicting that the bank could have to raise rates by 1.25, which would bring the policy rate back up to 4% and the prime rate up to 6.2. Far cry from the 22.5 prime we saw in 1982, and certainly not a doubling of mortgage payments that borrowers saw back then. So, at first glance at least, the hit to the housing market doesn't sound that bad. Though, as we'll see, I definitely wouldn't count out the impact of the renewal wave already starting as we speak, which was, and is, going to be a problem well before the Trump tariffs.
Shut up.
So, while we might see some interest rate hikes caused by higher inflation, that inflation is nowhere near as high as it was in the late 70s, early 80s, and as such, those interest rates won't be nearly as high either. But that's just the inflation interest rate part of the equation. What about unemployment? Well, according to Oxford Economics, unemployment is set to hit 7.7% in the latter half of this year, up from right now's 6.6%, a 15% increase, though nowhere near the near double increase that we saw in stagflation during the 1980s. But, and here's the key, smaller increases in the unemployment rate are going to have a much bigger impact on the overall economy, on households in general, than they did in the 1980s. As, back then, the debt to disposable income ratio in Canada was 66%, compared to the 172% that we have right now. Meaning, every little bit of interest rate increases are going to pull that much more marginal cash out of the economy than they did 40 years ago. As such, I'm not sure that 7.7% unemployment rate is entirely feasible should these tariffs continue. Remember, even back in 2023, David Rosenberg was noting that mortgage renewals were set to increase by 30% in 25 and 45% in 2026, noting how those increases would lead to a reduction in discretionary spending, goods, restaurants, etc. Rates are better than they were back in 2023, but the tariff talk is pushing them back up. I had released a video in June of last year showing that if we had a 4% mortgage rate by the time this mortgage renewal wave started, that payments would increase by around 15% right around now, reaching 20% by February of next year. And what that means, combined with our debt to disposable income, is that every little bit that interest rate has to go up or stay high, as the case may be, means that's more and more money getting pulled out of the economy, meaning more and more pressure on unemployment. And finally, remember, when Canadians bought pre-1980, when they locked into that 5-year fixed term in, say, 1976 and onward, they weren't maxing out. Canadians that bought during this period definitely were.
And how?
And all of those Canadians are renewing into much higher mortgage payments as we speak. So, in summary, the stagflationary environment of the 1980s doesn't exactly provide a perfect parallel to what we're seeing right now. In that, in the 1980s, with much, much lower debt levels, they were actually much more apt to handle it. As such, I'm not sure the stagflationary pressures in the 1980s that pushed down that housing market will be the exact same pressures that pushed down this one. But that's just due to very different starting positions. The amount of debt that Canadians have racked up over the past 40 years, as we've seen, can and will pull a lot of money out of the economy. As such, I'm not as sure that it's inflation and interest rates that will directly push down the housing market, but rather it will be the economy. It will be the double whammy of the tariffs pulling money out of the economy and that problem that we've had lingering since 2022, the mortgage renewal wave pulling money out of the economy as well, both of which were not present back in the early 80s. So yes, stagflationary pressure set to hit the Canadian economy as this goes on, but the transmission mechanisms to the real estate market are going to act very differently than they did in the 1980s. We're not so much expected to see interest rates in the high 10s, high 20s, but the interest rate hikes that we do see, assuming we see some, but the interest rate hikes that we do see could have just as much of an impact on the average household due to different starting positions. We will obviously continue to track how all of this interplay works out on this channel. Make sure you click, like, and subscribe if you want to get those updates, but for now, thanks so much for watching.